let's understand the guide of smart investing, which will help us in navigating the investments into small cap and mid cap and will reduce our risk or exposure to this section of a capital market. So first of all, when we are investing into a small cap and mid cap, we should invest across different sectors and different cap size. So when I say different cap size, it's a market capitalization. We should not invest or we should not have a higher allocation to small cap and mid cap. Always you should have a higher allocation to large cap, and maybe a small cap and mid cap should be allotted a small portion of money. Depending upon your age and the risk appetite, you should not have more than 15 to 20% exposure to mid cap and small cap. If you are young and you have a higher risk appetite, then probably you can increase it to more than 20%. Another best practice or option of having an exposure to small cap or mid cap is through mutual fund or exchange traded fund. Because first of all, the schemes, whether it's an ETF or mutual fund, right, are professionally managed by an individual who are daily involved into the business. They are not emotionally attached and they understand the various risks and they know how to manage those risks. That's why investing through mutual fund or ETF do carry a lower risk than directly owning this small cap and mid cap. Within mutual fund, maybe you can go for a flexi cap like a scheme wherein the fund manager will decide, depending upon market condition, whether they should invest into large cap, mid cap and small cap, and which segment of the market offers them a higher return or return potential. Another way of investing into these mutual funds or ETF is through SIP. You can start SIP into all these mid cap and small cap so that you can average out your price and you can get the better returns from these mutual fund schemes. Of course, you can carry out your own research. If you have time and resources, research resources available, you should carry out your own research about the revenue trends of a company, the promoter, the debt level that company have. And if you are confident and if you have that kind of conviction, then probably you can take that kind of exposure to that company. As long as the business performance of a company is good, the fundamentals and the cash flow of the company is good, you should remain invested. So always look or go for companies, even if it's a small cap or mid cap company, which distributes a dividend to its investors. Avoid penny stocks. When I say penny stock, stocks which are small in denomination, in a single digit or double digit, which can be easily managed by any broker or manipulated by any individual with a low credibility of a business. So you should avoid, because they do carry the highest price risk. The important factor of creating wealth or higher appreciation through small cap and mid cap is not by trading, but by investing into those convicted companies and remaining invested for a longer period of time. Maybe you should wait till the complete cycle plays out. We are talking about the economic cycle, and then probably you'll be able to reap the highest benefit in terms of capital appreciation.